It is said that this money goes into the pool for pension for the Canada Pension Plan. And then there's money that also goes into employment insurance. And now, how much of that employment insurance do most Canadians end up using? I mean, I think that's interesting to dive into in the future, to look at how many Canadians actually really rely on employment insurance compared to what they've actually contributed.
For every dollar over that 200,000, 52 cents of every dollar you get to keep and 48 cents of it is gone and never to work for you and your family again. What exactly is a marginal tax rate and how the heck does it apply to me? What are my actual taxes I'm going to pay living in Canada? That's what people really want to know. And the problem is, well, it can get a little confusing. So today, I'm joined with my good friend, Henry Wong, and we're going to have a little discussion about that as we talk about this in the book, Keep Taxes Away from Your Wealth. What exactly are these tax rates and how do they operate? And we're going to use an example that we highlight in the book to explain basically how the tax gets chopped up at different segments of income to then produce a total tax bill. But then we have to understand and separate, there's different authorities that want to receive a tax bill. We have provincial taxes and then we have the federal taxes. So we're going to take a look at all that and we're going to use an example that we talked about in the book. I think we're going to have a little bit of fun with it, Henry, because this is a kind of like a little bit of a mystery, I think, for the average Canadian. And I suspect our North American on the south of the border similarly have some issues really, truly understanding what are these tax rates that we're actually paying.
The taxes, when we talk about in Canada, what we hear terminology like it's a progressive tax system, or there's average tax and there's marginal tax. The key takeaway that we want to accomplish, at least, is sharing that the myriad of rules that are involved, that are written in the Income Tax Act, makes it so complicated that it comes generalized in an easy way to explain some things. So people kind of know, oh, my average tax bracket, my tax rate around is around 25 or 30%. But let's kind of dive into the layers to bring a bit of transparency to see the mechanics of it. And just as a full disclaimer, when it comes to even calculating it, we're going to go through doing it from a manual approach, because now we have a lot of software that helps calculate taxes. Whoever files your year-end tax returns, or anytime you're filing taxes to report to the government, there's software tools that will do it. And those are usually the more authoritative, accepted measure. But, to kind of work through the mechanics or the logic or the algorithm of that calculation is quite difficult if you were trying to unpack it manually.
Part of that, I think, is important that you identify is that if you have the bookkeeper, your accountant, or maybe you even are filing, let's say you're filing it yourself and you're plugging all your numbers in, like maybe you have a simple couple of T4s that you plug into ABC software. The issue is that you're waiting until the very end, after the tax year is already over, and you're already maybe a month or two past that trying to figure out those numbers, in which case, to some degree, it's too late to know the number. If you want to actually start doing some effective planning and understanding of your system, the more that you have a deeper understanding of something, the better you can make decisions about it on an ongoing basis. So that's part of why we want to unpack this a little bit here, to help heighten that level of understanding so you can see a little bit more visually the impact of how things get chunked apart relative to the amount of money that you're generating, the work that you're doing, and the amount of that work that's leaving relative to how much effort you put in.
Maybe just as a quick overview in terms of tax system, the terminology that's used is the progressive tax system. So what that means is that the more income you make, the more that you will end up falling into specific brackets, or the higher brackets you get, and that those brackets are associated with higher percentage rules that get applied for it to be taken off of that income that you've generated. And on a very simplistic standpoint, the type of income you earn is categorized in particular spots and defined in a very particular way. So, and I'll use the terminology capital. So you will receive capital, in our case, in the form of money or currency. Now, how that currency has come to you and what it's defined as, whether it is investment income, capital gains, or dividend income, or earned income, those will be filled in to particular boxes in the tax form. And those particular boxes essentially accumulate to formulate your income, but they will attract very different rules to those income boxes that you've put them into. Plus, that size will attract a particular rate that you fall into. So again, just trying to unpack a little bit of the complexity behind the system. Now, once you have filled out your numbers and what you've received in the form of capital and where it goes into, the tax system in Canada and how it works is it's based on a person who is a resident in Canada, and they are going to be taxed on their worldwide income, not just what they earn in Canada. And these are the rules that are written in that Income Tax Act. And before, the Income Tax Act used to be a small little around 40-ish page book back when it first came out back in 1917. And now it's thousands and thousands of pages behind all of that.
Similar to what Henry said, I think it's important to understand the complexity of that system. And as we progress through time, it seems to be that the system isn't getting easier, it's actually getting much more complex. And I think it's reasonable to understand that by showing a simple infographic. So we track this down here on the Fraser Institute, a nice little infographic. Now this shows the total number of tax lines just on provincial tax forms. As an example, 52 lines in the year 2000 versus 172 lines in the year 2015, based on the provincial average. So again, this is a huge increase, 232% in that 15-year period of time. Well, we're a number of years later than that. And I'm pretty sure, Henry, if we were to go and assess, we would easily be able to find additional lines that have been added since 2015. So the constant adjustments and changes to the tax system on a year-by-year basis is another way of, it's almost like a hidden tax in a way, in that it increases the complexity. So it becomes a tax on your time to some degree, or the time of the professional, the bookkeeper, the accountant that has to complete your tax return for you, because now you progressively have to pay more for them to do a similar amount of work because it's more work for them. I don't know about you, but most people don't want to do more work for the same amount of money. Usually it's the other way around. They're happy to do more work as long as they can get more compensation for doing it.
For the average Canadian who's not in the level of details looking at that, the tax professional, there's a lot more work for me now. And as the average citizen looking at it, like, what are you talking about? I didn't change. I'm still the same employee from those years ago. But now there's more reporting that needs to be put in. Just as an example, a very simple example, in 2016, 2017, they introduced a rule that you've got to now report your principal residence on your tax return. And for even someone like me, I'm like, what is going on? Why do I have to, if I've not been involved in my own finances, why would I have to suddenly start giving you that extra information? You never asked me that before. And that is also, examples of additional work that gets added on to just filing your tax returns. And the most interesting part is CRA, who is responsible for administering this whole tax program, they are actually having you pay your professional to file taxes that you are working for them to file your own tax return. That sounds a little bit backwards to me.
And if they don't like what you filed and they want to come ask you some questions, you have to pay for that too.
Yeah, that's exactly right. So somehow all that onerous responsibility, the time and the resources expected on you as the citizen. I mean, you get to file what you get, but if they come back to you, you're going to have to support the audit, which means you have to pay for those costs to either the professional to help support you or find the information or interpret what the auditor is asking for. And you have to be the one who record keeps everything so you can defend yourself. All of that is unspoken, uncaptured administrative costs that are borne onto you while they are increasing these extra layers and lines and complexities as it comes to interpreting how much tax you got to pay for your income.
It reminds me of something that the late R. Nelson Nash used to say, is that the consumer pays for everything. And in this example, the consumer is most definitely paying for everything here. What's curious about some of the things you identified, again, the increasing complexity of the number of tax lines and tax rules and then changes, and et cetera, is because of that continual change and update. Obviously, the tax professionals need to go for continuing education. We understand that. But it becomes harder and harder and harder for them to be a ninja at all aspects of the taxation and tax preparation, but also being able to really, truly dial in and hunt for those ultra-specific little rules that could create an advantage for the taxpayer. And so the more of those loaded changes that are occurring, the more difficult it could become for the professional to be like, wow, hey, here's exactly how we can help you save a little bit on this thing because of what's unique to your circumstances. So the reality is you're always trying to find a way to create the best possible advantage for yourself, as you should, and you're entitled to do. And we want to help by just uncovering some of the overall complexity here by helping you understand just fundamentally, how does just the tax rate component work? And we're going to look at an example here based on on someone in Ontario. We've chosen that because number one, it's one of the largest population bases in the country, and number two, they have some extra funny rules, which I think are particularly funny. So we'll talk about that. And then number three is they also have one of the larger residents of that province tend to have slightly higher taxation than some other provinces. That's why we've kind of chosen that as a dynamic. And again, if you live in a different province, we can point you in the direction of some ways you can determine some of these calculations. But ultimately, we're going to use the Ontario example for the purpose of what we're going to do today.
Aside from all the growing myriad of rules, it's important to kind of get a good grasp of the concept or the architecture of the act in a very simple way so that you at least know how to generally navigate around it. You'll still need to rely on the expertise of a professional who lives into that detailed area to know those specific rules. However, it shouldn't prevent you from being lost. At least it's a good GPS to say, is there an opportunity for you to be more involved in your ability to keep taxes to the minimum legally required amount? And we've put together an infographic, and the infographic that we put here, just as a disclaimer, it's a applied version for educational purposes. It's not exactly precise. And the reason why is actually there's a lot of interpretation that can come into it. And we'll show you from other very established sources who use their own income tax calculator, and they will come out with very differing results. And that just as a way shows you there's no unified standard of how income taxes are calculated and filed, and the interpretation, even from different softwares, can be very, very different. Let's just kind of dive in, again, just from an educational perspective, to see how your income levels will result in how you're getting taxed. When you earn a capital of $200,000, just as an example. So you'll see here, there's $200,000 of capital defined as gross income. And this example we're using is an individual who's earned a T4 income. So now when you receive that money, eventually that money is actually also being reported by your employer. And also it's going to end up being reported by you as an employee. And that number gets filled into, when you receive your T4 statement, that number gets filled into a particular box for the CRA's filing system when they receive all of that information to calculate and see if the amount of tax you receive is, aligned with what they have in their back end. So going back to that estimate, that $200,000 of gross income, we're using Ontario, and Ontario has bracket to go through. So does federal, because there's federal portion of it and then there's a provincial portion. So if we look at the bracket in this example, 200,000, it goes through the first bracket, which maxes out at $7,530, and there's a particular percentage rate that gets applied on that bracket. The next level of amount that goes through that goes into that $10,290, and then the next third bracket, it goes through to $14,361, and then the final bracket of that goes to $12,869. So each of those, if you were to slice up that 200,000, the bracket gets filled up at each particular point, and that's how much taxes get removed off of that income. So that's how the federal bracket works. And similarly, in Ontario, the brackets will work exactly the same way. However, specific to what Richard was referring to before, there is what's called an additional tax in Ontario called a surtax, and that calculation is shown here at around $5,842.
It's fascinating to see it in this format because we understand there's brackets. Everyone knows that there's brackets. Not many people know what the percentage of those brackets are or what the cap is. This is identifying how much actual dollars of taxation is being removed from each one of those brackets. So in the first one in Ontario, there's $2,334 out of bracket one, and then bracket two, it's $4,230. As you progress through the income thresholds, the amount of money that's pulled out at each bracket kind of chips away. It's interesting to see the volume of those dollars, both from a provincial side, but also from the federal side and how they differ. Adding into the surtax idea, again, that's one of the reasons why we chose Ontario, because they have a unique thing. And they're not the only province that does, but there's not many provinces that have the same idea. And so recognizing that there's basically a completely different tax, which doesn't fall into a bracket, but is a required payment relative to the amount of income that you're generating. For this $200,000 income individual, we can see how everything's getting chopped up in multiple different ways. It's kind of like just watching a vegetable in your kitchen being chopped up, and there's only so much left available when you go to put the rest of the thing back in your fridge because you used a bunch of it. It's an interesting visual to see how you worked for the 200,000 and the total amount of that that's going to one institution from the federal perspective and the other institution from the provincial perspective, just kind of basically ripped out of your earning potential.
For that Ontario portion, the first 46,000 of the 200 goes through 5.05%, which is what gives that 2,334. And then anything above that 46,000 to 92,000 is applied now the 9.15% rate. So now the first 46 of the 200 is 5.05. Then anything above that gets then applied a new rate. Notice the rate is actually almost double from that jump there. And so that's 9.15%. to then max out at 4,230. And now, since the 200,000 now goes to this bucket from 94 to 150, and that gets applied 11.16% to the 64. And then, just following it all the way through. And then, this individual didn't go over to the 220 bucket, but basically is paying rates at 12.16, 11.16, 9.15, 5.05. And when you put it through that scale of income into those categories, that's how that income is getting put through in that progressive income tax system. The more income you earn, the more, first, the rates are higher on that chunk or that bucket. And obviously, it's not just a flat 5.05%, the more taxes you are paying because the volume of dollars you have is much higher. And so you're going to end up paying heavier and heavier tax on that size that you're putting through.
Which is where the idea of the marginal tax rate or the effective tax rate now comes in. And that's something I think we'll talk about as we go through this. But before we jump to that, Henry, I'd love to scroll down on this and actually see what does the summary look like now on these income charges. And so if we look at the federal side, we can see here over $45,000 went towards the federal government through their tax bracket system when it's accumulated. Now, on the provincial side, we've got $19,000, which includes, in this case, that surtax amount. The surtax is almost $6,000. Then you have to take those numbers and you have to add on another payment that goes to the federal system, which isn't exactly a tax, but it ultimately is incorporated in your tax return, and it's a payment that must be made. And that's your deductions for CPP and the employment insurance program, because those aren't mandatory. Those are requirement. If you're earning salaried or T4 oriented income, there's an automated calculation that has to be taken into that consideration. So that's an additional $4,453. Now, in our example here, we're using 2022 numbers. So actually in 2023, that number will be higher in this example. And the reason we're using 2022 is because some of the new tax tables at the time of this recording aren't even issued yet for us to be able to do this appropriate calculation and do the recording that we're doing here right now.
Even though these deductions for CPP and EI, technically under the definition, it's not a tax, but it's still dollars being removed off of the productivity of efforts that you put in. It is said that this money goes into the pool for pension for the Canada Pension Plan. And then there's money that also goes into employment insurance. And now, how much of that employment insurance do most Canadians end up using? I mean, I think that's interesting to dive into in the future, to look at how many Canadians actually really rely on employment insurance compared to what they've actually contributed. But we've done a pretty good video describing the money that goes into the Canada Pension Plan. And, I know, Richard, you and I have recorded a podcast talking about your own specific example of your contributions to the Canada Pension Plan.
You mean my confiscations, Henry? Is that what you're talking about?
Yes, yes. When we kind of put all the income through the brackets and we summarize it all together, that ends up putting the tax rate, essentially what you removed off of your incomes. The government system has removed $74,000 off of their income. That essentially is about that 37%. So of the total amount of income that was earned, 200,000, they've lost 74,000, or it's been removed from their income to get put into the government's systems in the form of taxes, surtax, CPP, pension, and employment insurance.
That is a pretty large number, 37%. So you did 100% of the work and the effort, and 37% of your work and effort goes to someone else. That's another way of kind of looking at the information. When you scroll down on this now, Henry, what we can see is the net. And so that leaves this individual or this family a little over 125,000, roughly $126,000 of spendable value, that now with that after-tax capital, they have to now cover their living expenses. And so that includes their car, their home, their heat, fuel in their car, maintenance on the vehicle,
groceries,
family
living,
vacation and living. But presently, at the time of this recording, the highest inflationary environment in a 40-year time frame. So it really starts to paint a picture of how Canadians have struggles that they're dealing with around the way their money gets chopped up, and not necessarily having a full visual to understand how that chopping up of the money takes place.
I was just looking at some of the amazing things around how much Loblaws was charging for chicken breasts, and you'll see here, chicken breasts at the time of this recording is about $37 for $26 a kilogram, $27 a kilogram, $37 for 3 chicken breasts.
That must be some pretty tasty chicken.
I sure hope so. This is what that individual will have to work with, 125, to deal with things like those groceries. Now, the chicken breast that individual paid for, $37.03. Now, there's also additional taxes. So what we just covered before was all talking about income taxes based on your productivity and your efforts. Now, there's a set of taxes that come from when you deploy your money to spend it and use it. So using the chicken breast example, that $37 and $3, you don't just walk into the shop and give the cashier $37.03. You actually have to give $37.03 plus a spending tax on that, which is a consumption tax, or HST, which is in Ontario, HST. So that $37.03 is actually a lot higher than what you are actually going to be paying. And if you think about it, chicken breasts before was about $5 maybe for 3, and now it's 30. And if I did 13% of HST on that $5, that's $5.65. So 65 cents went to the government in the form of consumption tax. But now with the chicken breasts that I was sharing with you, $37.03 times 1.13, now you're paying an extra $4.84 in consumption tax because the product cost has gone up. So consumption tax has also indirectly gone up because the base of what it's been calculated on has gone up. So that's now, as times are where we are right now, with $125,000, it sounds like a lot of money. I mean, it's not a lot compared to what was initially removed from the income tax. Now we go down to the consumption, and we have other things. We didn't include groceries in this, but we kind of put some rough estimated examples of property tax, $5,000, depending on the size of property you have, the location and the region.
The value of that property relative to what the market has done. So again, we're looking at an Ontario individual here. We all know that in the last number of years, there's been a huge spike in real estate prices in the Ontario market. So $5,000 property tax payment is certainly not unreasonable. I think when we talked about this before, Henry, I think you actually thought it was a low number, depending on what area you live in town.
That is absolutely correct. And then there's fuel and carbon taxes. So things like fuel or heat that you're paying. I mean, I know countries in UK or all those other countries too are paying through the roof right now, Europe, in fuel. And it's not just because of the cost of it. There's also a layer of taxes that's included in that fuel. Well, Canada also has a very similar setup when it comes to using that fuel.
The fuel tax and the carbon portion on there is actually based on about 160 liters of fuel filling up a vehicle or 2 vehicles per month. We're not talking about a monstrous amount of fuel that the average Canadian uses driving to and from, say, work on a daily basis.
Not the big truck gas guzzlers. These are just regular family sedan type fuel conserving vehicles. And then, GST or HST, depending on the type of purchases that you make, that's kind of a portion in there. And then some people will have their spending related to alcohol, tobacco, or, even sugar, they're taxing for about $1,380. So aside from just taxes on income being $74,410, when you make that spending, I mean, the property tax, if you own a home, you end up paying taxes for it. But the other things that you're consuming, just by standing there, you have to pay an additional approximation of consumption tax of almost $11,000, which is 5.5% there.
Well, and interestingly enough, even if you don't own the home and you're renting the home, most rental property owners, they're the one that has to pay the property tax, but they don't actually pay for it. The person living in the rental property pays for it through the rent. So even if you didn't own the home, or, so if you're talking about a principal residence, cool, that's covered. But if you live in a property, which most people do, and you are renting that property, the property tax is still being paid. And most likely as the renter, you're still paying for it. It's just through an inadvertent circumstance. So I still think that if you're, anyone living in a property, the property tax is being paid, someone's paying it, most likely it's you.
I just want to kind of go back a little bit and go talk about the income tax portion and showing you. So as you can see, it's relatively a lot of brackets to go through, and the interpretation, even in the brackets on how it's applied, can get messy because there's something called non-refundable tax credits, and not everybody's non-refundable tax credits applied a certain way, and the methodology it's being used is also not exactly consistent. So again, that brings a myriad of differences. And so let's kind of walk through, just as an example of some differences. I pulled up just 3 random, just on Google, retrieving some very public tax calculators, and Ernst & Young is a very big professional services firm who has personal tax calculator for Canadians for 2022. And again, we put in $200,000, and you'll see that for Ontario, it's $131,374 compared to our calculation of after-tax income of $125,590. Now, one of the things that if we look in the fine print, we'll see that these calculations do not include non-refundable tax credits and other basic tax credits and all this other disclaimer information, just to essentially show you that that's one source of showing one difference from our 125. And then here, I'm just using Wealthsimple. They have also another calculator. And if we look at Wealthsimple, we're putting in the same $200,000, the tax $72,500, where the after-tax income is $127,500, where if we look at it from Ernst & Young's perspective, it's $131,374. So it's a pretty sizable difference, about $4,000. Also, these calculations are approximate and include the following non-taxable credits. So they have, in their methodology, included non-refundable tax credits. And then I'm just going to show one other calculation here, another sort of calculator software, and we look through, and their tax payable is $68,626.50, and they don't really describe their disclaimers on their methodology on their calculation. However, what I just wanted all of you who are watching this to realize that there is no consistent number across the sources that you use. And these are all 3 very well-resourced companies that would be able to dive into the details, find the specific calculation, but you can realize that every individual is different, and there's an individualized component to when you're calculating your taxes. And this is where the introduction of where people talk about the average tax rate, where after all of that calculation, if you just divide the 72,500 divided by 200, that's 36.25%. But we realize it's not exactly how it works, because there's different brackets and percentages that get applied to it. But on average, after you take that final number that gets removed off of the gross income, that tax is 36.25. Then there's something called marginal tax rate, which a lot of people may not actually get in terms of understanding or how to explain it. And here's how I would explain it in this way. With $200,000 of earned income, one thing that people may lose sight of is they are very attracted to earning more income because they need to make the bottom line higher, which is that after-tax income. However, one of the things that really becomes disincentivizing, that if you don't actually look into the mechanics of understanding of how the calculation works, this is where you are feeding into the system, and then something becomes a very big problem. And this is how it becomes a very big problem. That $200,000, if you now earn $210,000, so that $10,000 that comes like you've earned $10,000, well, because you're now at this high tax bracket, any money that you earn on top of that 200 is going to get taxed at 47.97%. Again, this is just an estimate. This is not the exact number. So that means that you're only going to get 5,000 of that 10,000 on top of the situation or context that you're in now. Because your income level is so high in the system of the progressive tax system, any incremental earnings that you get, that you go through, is 50%. This also plays a factor when it comes to planning on how you get additional income coming into you. and what do you need to do with it? Very few people, what I sometimes hear horror stories about is they're in such a high position of income and they need to get money out of their RRSP. And this is where they will withdraw money out of their RRSP and they end up they only get half of that back.
Well, I think it's just very telling, like your explanation of the marginal tax rate, I think is really important for people to take heed of. So again, for every dollar in this example, we're using everything's based on this $200,000 income, but for every dollar over that 200,000, 52 cents of every dollar you get to keep and 48 cents of it is gone and never to work for you and your family again. Now, if you are in a position where that money, let's say comes, again, it's a T4 situation, well, that percentage of that is really held off the top. It doesn't really, or else you have to pay a big chunk of it at the end of the year. It is an eye-opening understanding. And so in this example, we didn't even go to the following tax bracket. There's a whole nother bracket still above what we've listed here. It's very interesting to recognize just how much of our system has us working really, really hard for everything that we want to have and achieve in our life. And it has a lot of that hard work going out the door where we can't work with it or use it again to support our family. So part of the work that we do is to try to help people, A, have understanding of that, and B, then try to strategize on how they can maintain more control and usage of that capital. And what's interesting about our graphic here, Henry, is when we look at the total tax taken from the taxation system, and then reasonable estimates based on natural spending patterns of the average Canadian person, the amount of additional tax through consumption and variability that is estimated there. I think we're at roughly about a 42% kind of ratio there, somewhere in that range. What's curious about this, if we add those, the combined amount of that total taxation up, okay, there's 42.5% of our money that goes towards some form of taxation in our life. There was a report done in 2022 from the Fraser Institute, and it actually specifies exactly that same thing. It says that the average Canadian family pays about 43% of its income to taxes. And that's including the income taxes that we've discussed, but then also those variable ones, which they're a bit nebulous, and that is going to change and adjust per household, per family. But if we're looking at, again, we're doing an average, that's what it is. We're taking all the Canadians and smashing them together and saying, here's what it looks like. That number is greater than what you're spending or have left to really spend on clothing, food, and housing. Next year's number is probably going to be very different, but I think this is a really telling tale about how our system operates, and for us to have some clear understanding of that, so that, again, through understanding, we can start to make new decisions or start being more mindful of our decisions about how we're interacting and integrating with the system that we're a part of.
Yeah, because there's definitely in the system that we're in and how you're earning, let's say that earned income, and there's a plateau of results despite you putting in more effort. You may receive more money on the top, but on the back end, a lot of that is getting removed off of you. And so you're going to have to reevaluate. Is that the most efficient and effective use of your, let's say, time to get that income? It will become a diminishing set of returns, because once you hit above the 220 mark, you're getting now taxed even higher in terms of the progressive tax bracket. So if you're at 200,000 and you get $30,000 extra, that actual $30,000 extra is not going to be beneficial for you as it may actually come out to be. So that's going to be where, again, in some of the ideas that I share in the book, there's alternative strategies for you to think about. Again, it depends on the context of how you are working and receiving that income. But that $30,000 might need to start being reevaluated on how you need to receive that income to properly plan, so that you don't expose yourself to that diminishing return of the higher marginal tax bracket.
I definitely think we covered a lot here, Henry, and I think we've exposed to some degree a little bit of the mystery behind the breakdown of these tax rates and the confusion that can be created by the different brackets by just showing visually how they get kind of chopped up. It's easy to go and find an online calculator. However, we've also proven that all those online calculators don't necessarily tell you the full story. It's nice if you get to know or have a projection on the net amount of money you're going to have or how much tax is going to walk away, but it also hides how that tax is broken down, so you can see why it is that way. When you have a better understanding of the why it became so, then again, you have a better capacity to start to recognize what you might do about it into the future. There's so much more to learn about the tax system, more to learn about you being able to keep more of your own wealth and to keep taxes away from it. And we'd encourage you to continue that journey of learning. Go ahead and take a look. There should be another amazing video popping up on the screen right about now, and lots more you can dig into as you start to take more control over your family's wealth.